charitable planning real quickly. We're just going to quickly go through it because time is constrained and you guys have been so kind to stay a little later. The goal is to use charitable planning and still be able to increase your ability to save for retirement. So you could do a charitable remainder trust and have it paid out for your lifetime and have it last longer than your IRA. So if you contribute assets to a trust like that, and it's for your lifetime, it'll actually, it's like, it works like an annuity. It'll pay you out for your lifetime using your assets, and then at the end of your life, what's left goes to charity. There's a tax benefit associated with the gift to the charitable remainder trust. There's tax benefits of having the assets owned in the trust, and then at your death, whatever's left is excluded from your estate. You get a deduction for it. So there are great techniques that using tools that are permitted under the law to increase retirement income, to increase tax deductions, and to help charity. Bottom line is, anytime you're doing charitable planning for your clients or for yourself, you have to be charitably inclined. That's the bottom line in all of these. Now, let's say I do one of these techniques. I do a charitable remainder trust, and assets are being taken out of my estate and given to charity and away from my kids. But I'm getting tax deductions for making that gift. I could use the tax savings from the tax deductions to purchase life insurance and a life insurance trust to replace that wealth that I'm transferring to charity. That's known as a wealth replacement trust. But all it is using the tax benefit to fund life insurance and put it into a life insurance trust to replace the assets that went to charity. So you really aren't losing anything except for the fees to generate it, and it's not that costly to do. The annual insurance premiums can be significant, but if you have enough from the tax savings generated from the gift to the charitable trust, then you can just put it into the trust and then let it pay the premiums over time. Maybe 7 years, maybe 10, maybe 15, depending on what kind of structure you choose. So I've mentioned charitable remainder trust. That means you make a gift to the trust today. You or your spouse, or you and your spouse, can enjoy the benefits of getting a payout from the trust for your lifetime or a period of years. There are very specific rules on this. And at the end of the charities, at the end of the lifetime or the end of the term, it goes to the charity. Charitable lead trust works like a GRAT. GRAT says, I make a gift to a trust, and the trust is going to pay me back an annuity based on the fair market value of what I put in. Again, maybe using discounts, valuation discounts to lower the value of the gift. And I can actually do it so that there's no gift that's made, and at the end of the term of the grant, it goes to my kids or a trust for the benefit of my kids. And I can make it as short as 2 years or as long as 10. The charitable lead trust does the same thing. It says for that period of time, 5 years, 10 years, 15 years, 20 years, I'm going to name a charity as the beneficiary at the lead of the trust, at the beginning of the trust, for that term. And then at the end of that term, it goes to my heirs. So it's the opposite of what the charitable remainder trust is. Again, very specific tax requirements for both of these. But they work really, really well for estate planning and estate tax planning, particularly for high net worth individuals and high net worth families. Question?
So with the CRT, we're all living longer. Is it possible to actually live so long that you actually use up all of the amount actually in the charitable trust?
It is possible. Yeah.
If that's the case, does the IRS actually do a clawback with the tax deduction that you got?
No, you have to, at the time of creation, you have to be able to establish at the time of creation that there's at least a 10% remainder for charity. If you can't establish that at the beginning of the trust, it's not a valid charitable remainder trust. And there's a court case that just came out last week on this, where the taxpayer was trying to use creative ways of arguing that there was a 10% when there really wasn't at the beginning, using valuation arguments. So that's one of the key requirements. in the old days, before they changed these rules in '97, you would be able to, play games with charitable trusts so that you could get the charitable deduction and then pay it all out to yourself and not have to pay tax on it. And they've done away with a lot of that. So there's very, very, very straightforward restrictions on charitable remainder trusts. But still, there are ways of not gaming, but structuring the charitable remainder trust to minimize the adverse tax impact to the donor, actually to maximize the tax effect to the donor. NIM CRUTs, flip CRUTs, there's different techniques that we use. Separate seminar. So it's basically you make a gift of property to the trust, annual income for life, it's what I've described. And then the charitable organization is the final beneficiary. It delays the impact of capital gains. So I had a client call me, his company is public, called me on a Friday and said, we're getting ready to be sold next week. I said, next week? Okay, maybe I can help you. What's the status of the transaction? The board's meeting on Sunday to approve it. I said, has the board essentially rubber stamped this transaction? What we were trying to do is contribute some of his assets into a charitable remainder trust. And then when the M&A transaction closed, the capital gain is not taxed. So he contributes shares, capital gain's not taxed. Now any distributions that he gets out are going to be taxed. It's going to carry some ordinary income and some capital gains tax treatment. But this is a great technique to minimize capital gains. Well, it was so close in time that we couldn't give him any comfort. But there are rules relating to that. And I've even done one for your group many years ago where we had a guy come in and he hadn't signed the letter of intent yet. We did the charitable remainder trust and then he entered into the transaction, sold it, got the capital gains treatment. There's IRS rulings and case law and all that stuff. So I don't want to hold you here all day. What I want to do is say thank you for coming in today. We've got another scheduled appointment on October 14th, I believe it is. It's coming up. It's our last boot camp session of the estate planning boot camp. We're going to be covering niche strategies in that. It's going to be very interesting. Pet trusts and supplemental needs trust and gun trusts and things that you may have heard about but wanted to know about. It's interesting stuff. Gun trusts are for people that own Class 3 firearms, by the way. So anybody with a tank in their backyard, please be careful. And then we'll also have awards for those who made it through all 6 sessions. Next year, we're going to be doing a boot camp for business planning. It's completely different than the estate planning. It's going to be covering, starting up new businesses, choice of entity, executive compensation, structuring contracts for your clients or understanding what the key points in those areas are, and then selling a client and business exit strategies. So it'll be fun. We'll have probably 6 sessions. We've already planned it out. Very excited about that. To add to your arsenal of weapons in helping your estate planning, business planning, all your financial advisory clients. Any other questions? Thanks again for coming. Appreciate it.